Welcome to The Explainer. Today, we are pulling back the curtain on the world of investment banking, and we're going to use some pretty shocking revelations to see how it all really works. Let's get right into it.
Let's just start with that quote, because it just perfectly sets the stage, doesn't it? This isn't from a movie. These were the actual names traders were using for their secret chat rooms while they were rigging some of the world's most important financial markets. It really paints a picture of a system that can feel less like an economy and more like a casino where the house always wins.
So our first dark secret is exactly that. It's about how some of the most fundamental markets on the planet, we're talking about the ones that directly affect your student loans, your mortgage, your savings, were being systematically manipulated from the inside. And at the very heart of this was something called LIBOR. Now this might sound technical, but it was basically the global interest rate. It set the price for trillions of dollars in loans all around the world. It was supposed to be this honest, average number, but it wasn't. Banks like Barclays and UBS were caught, get this, just lying. They were making up numbers to nudge the rate just a tiny bit, but a tiny bit of a trillion-dollar market means absolutely massive profits for them.
And it wasn't just interest rates. They used this sneaky technique called front-running. This analogy here explains it perfectly. Imagine a huge client, say a pension fund for teachers, wants to buy a ton of stock. The bank sees that order coming. What do? They quickly buy that same stock for themselves seconds before putting the client's order through. The client's massive order drives the price up, and boom, the bank immediately sells for a risk-free profit. You literally just got cheated by the very people you're paying to help you.
Okay, so rigging existing markets is one thing, but this mindset actually went even further. It wasn't just about cheating the game, it was about creating brand new, incredibly dangerous financial products completely from scratch.
And that brings us right to the core of the 2008 financial crisis. You might have heard of these things, CDOs, or collateralized debt obligations. Here's what they were. The banks took thousands of really bad home loans. I'm talking about loans given to people who had no way of paying them back, and they bundled all this junk together. Then they paid the rating agencies to slap a safe, pristine, AAA rating on it. They were literally selling ticking time bombs to investors, like other people's pension funds.
And the most infamous example of all has to be this one deal from Goldman Sachs. It was called Abacus. Just look at this. On one hand, they were telling their clients, hey, we've created this high-quality investment for you. But secretly, behind the scenes, they were building this thing specifically because they expected it to fail. Why? So they could make a fortune betting against it. It's the equivalent of knowingly selling someone a broken car and then taking out a massive insurance policy for the crash you know is coming.
And when all of these time bonds finally did go off, when the whole system came crashing down, who had to pick up the pieces? We did. The American taxpayer had to bail out companies like the insurance giant AIG to the tune of $180 billion just to stop the entire global economy from collapsing.
So, what you're hopefully starting to see here is this really fundamental problem. It's not just about a few bad products. It's about a huge conflict of interest that's just baked right into the business model itself.
Take Morgan Stanley. They were paid millions in fees to advise this solar company, SunEdison, on a big acquisition. That's their job as an advisor. But at the exact same time, their own trading desk analysts were quietly telling their other big clients that the deal was, and this is a direct quote, dog shit. So what are you? Are you the trusted advisor trying to help a company succeed, or are you the trader using inside information to bet against them? The shocking answer is, sometimes, they're both.
And you see this conflict perfectly with IPOs. That's when a company first sells its stock to the public. The bank basically becomes a hype machine. As you can see here, they often underprice the stock to guarantee a big first-day pop. They hype it up to the media and to regular investors like us. This creates a frenzy, the price soars, and that's when the insiders and the banker's favorite clients all cash out right at the peak. And who's left holding the bag when the price inevitably crashes back to reality? You guessed it.
And if you want a perfect example, look no further than WeWork. Investment bankers pushed for this valuation, $47 billion, for a company that was burning through cash and had never made a single dime of profit. Now, why would they do that? Simple. Bigger, crazier, more hyped-up IPOs mean much bigger fees for the banks, whether the company itself is a complete disaster or not.
And all of this builds up to the final and, let's be honest, probably the most infuriating secret of all. Even after causing all this chaos and damage, there is almost zero real accountability.
Think about this for a second. If you or I were caught doing something remotely like this, we would go to jail, probably for a very long time. But for a massive global bank like HSBC, who were caught red-handed laundering almost $1 billion for drug cartels, they were moving so much physical cash, one branch literally had to make its windows bigger to fit the boxes. For them, the consequences look very, very different.
So what was the punishment for laundering cartel money? Well, just look at this chart. They paid a fine, yes, a big-sounding fine of $1.9 billion. But that was less than a single month of revenue for them. It's a speeding ticket. And the number of executives who saw the inside of a jail cell? 0, not 1. The government actually declared them too big to jail because they were afraid that prosecuting them would damage the global economy.
So, remember 2008? Remember when millions of people were losing their homes, their jobs, their life savings, all because of the crisis these banks created? Well, while all that was happening, Wall Street was, pretty busy doing something else entirely.
That's right, $16 billion. That's how much Goldman Sachs paid out in bonuses to its staff, in the very same year that their behavior forced the public to bail them out. The disconnect is just staggering.
And you know, that public bailout that we all heard about on the news? That was just the tip of the iceberg. The real rescue was happening in secret. The Federal Reserve was quietly funneling trillions of dollars in loans with almost zero interest to the very banks that caused the problem in the first place. All of it done with no public debate, no vote, no transparency.
So you have to ask yourself, why don't the rules ever really change? Why does this keep happening? Well, a big part of the answer is what's called the revolving door. It's a pretty simple cycle, as you can see. A top banker works on Wall Street. Then they take a powerful job as a government regulator. While they're there, they help write rules that are, surprise, surprise, pretty friendly to the banks. And then, after a few years, they leave government and take an even higher-paying job right back on Wall Street. It's a system that regulates itself.
So when you put it all together, what are you left with? It really feels like a system where the profits are privatized for a select few, but the losses? Oh, the losses are socialized for everyone else to pay for. It seems to be a game of heads they win, tails we lose. And that leaves us with a pretty critical question to think about. Is this really the only game in town?